Stop whatever you are doing. Do not scroll. Do not blink. Do not assume this is another market headline. What you are about to hear changes everything you think you know. This is not speculation. This is not a theory. This is not social media noise. This is an institutional warning that was never meant to reach the public. Behind closed doors, inside glass towers, decisions are being made that will erase entire portfolios while most people still believe the system is stable. This story does not start with charts or prices. It starts with fear. Cold, calculated fear inside the risk departments of the largest banks on earth. 72 hours ago, a message moved through private institutional channels. No press release, no headlines, just a silent order sent to elite clients. The message was short, direct, brutal, 3 words that carry more weight than any market report ever written. The message contained only 3 words, but those 3 words carry more institutional weight than any forecast, report, or analyst briefing ever released to the public. In retail trading, that sounds dramatic. In institutional finance, it is an evacuation command reserved for markets on the verge of structural failure. This was not sent to the public. It was sent to hedge funds, sovereign wealth funds, and entities that move billions without asking permission. The origin of the directive traces back to one place: a top-tier global investment bank embedded deep inside the silver market infrastructure. This is not a bank guessing. This is a bank that sees real-time order flow, physical shipments, counterparty stress, and derivative exposure simultaneously. When a bank like this issues an exit directive, it means their internal models are no longer showing risk. They are showing inevitability. Words matter on Wall Street. They did not say reduce exposure. They did not say hedge volatility. They did not say rebalance intelligently. They used the word exit because, inside Wall Street, that word is reserved exclusively for moments when the system itself is no longer considered controllable. Exit means the bridge ahead is no longer safe. Exit means the structure underneath the market has already started collapsing. Exit means the price you see on your screen no longer reflects the danger beneath your feet. Even more disturbing, the directive came with a deadline, not weeks, not months, days. The deadline attached to the directive was not symbolic or flexible. It was fixed, final, and dangerously close: the end of this month. In institutional risk language, deadlines are only assigned when something unavoidable is approaching fast. This is not a warning about volatility. This is a warning about market integrity itself. Inside banks, silver is no longer being discussed as an asset. It is being discussed as a liability. A potential trigger event, a balance sheet contaminant, a systemic threat that must be removed before reporting cycles close. Because when month-end arrives, every position becomes visible, every loss becomes real, every risk must be justified to regulators. And some risks cannot be justified, hedged, or delayed. This is why the exit is happening quietly, before headlines, before panic, before the public notices the floor has disappeared. The bank issuing the directive is not alone. Others are watching, others are preparing, some are already halfway out. This is how financial collapses always begin, not with chaos, with silence. With institutions stepping back slowly, pretending everything is normal, while draining exposure behind the scenes. Retail investors see a calm chart. Institutions see stress fractures spreading across the entire silver market structure. They see something you do not, because they have access to data that never appears on trading apps or financial news. They see inventory movement, delivery pressure, counterparty weakness, liquidity gaps forming where none should exist. They see paper silver multiplying, while physical silver quietly disappears from the system. They see promises stacking on top of promises, all backed by a shrinking pile of real metal. And they see the moment approaching when those promises can no longer be honored. That moment is called a structural break. When it happens, prices do not behave logically, rules change overnight, trades are canceled, markets freeze without warning. Those who exit early survive. Those who wait for confirmation become the liquidity that allows others to escape. This is not about being right. It is about not being last. Right now, you are living in the gap between institutional awareness and public realization. And that gap between what institutions already know and what the public still believes is shrinking rapidly, compressing time, options, and exits into a narrow window. To understand why institutions are exiting, you must stop looking at price charts and start looking at the physical foundation holding the silver market together. At the center of this system sits a deceptively small number that almost nobody outside institutional desks ever watches closely. That number is registered silver inventory, the metal officially available for delivery inside the exchange vaults. Registered inventory is not theoretical. It is not paper. It is the last line of defense between promises and default. And right now, that defense is collapsing at a pace that has shocked even veteran commodities traders. Over the past several weeks, millions of ounces of registered silver have quietly vanished from the vaults. This is not normal drawdown. This is not seasonal movement. This is accelerated depletion with no corresponding replenishment. Just weeks ago, registered inventory stood comfortably higher, giving the illusion of stability and control. Today, that buffer has shrunk to levels not seen in over a decade, triggering internal alarms across institutional risk systems. What terrifies banks is not only how low the number is, but how fast it is falling. When inventory declines slowly, markets adjust. When it declines violently, confidence evaporates. Recent vault data shows losses measured not monthly, but weekly, sometimes daily, with no sign of reversal. This creates a simple but deadly equation: fewer ounces backing more contracts than ever before. Silver is not traded one-to-one. It is traded hundreds of times over through futures, options, and swaps. For every ounce of physical silver, there are layers of paper claims stacked on top of it. This structure only survives if most participants never ask for delivery of the real metal. Historically, they didn't. Traders speculated, rolled contracts, and settled differences in cash. But that behavior is changing, and institutions can see the shift long before headlines catch up. An unusually large percentage of contract holders are now choosing to stand for physical delivery. Each delivery request removes metal permanently from the system, tightening supply and amplifying stress. As more participants demand delivery, the exchange is forced to drain its registered inventory even faster. This is where the illusion of abundance begins to crack. Skeptics often point to eligible silver, claiming vast reserves still exist inside exchange vaults. But eligible silver does not belong to the exchange. It belongs to private owners using vaults as storage. Those owners have zero obligation to sell, lease, or convert their metal into deliverable supply. When physical premiums rise globally, eligible silver becomes even more tightly held, not more accessible. Institutions understand this distinction clearly, even if retail investors do not. Registered inventory is the only metal guaranteed to satisfy delivery claims, and it is evaporating. This creates a countdown scenario where time, not price, becomes the critical variable. Every day that inventory declines without replenishment brings the system closer to a breaking point. At that point, the exchange faces an impossible choice between honoring contracts or preserving itself. History shows that when forced to choose, exchanges protect the system, not individual traders. This means cash settlements, forced liquidations, or rule changes introduced without warning. Institutions do not wait for those announcements. They exit before they are made. This is why banks are not debating silver's long-term fundamentals right now. They are calculating how much damage occurs if delivery requests exceed available registered supply. Their models show that this threshold is no longer theoretical. It is approaching fast. Once that line is crossed, paper silver and physical silver stop behaving as the same asset. Price signals fracture, liquidity thins, and confidence collapses simultaneously across markets. This is the environment institutions are fleeing, not because silver is weak, but because the structure holding it together is failing. To grasp the scale of the danger, you must understand the arithmetic that governs delivery inside the silver futures market. Every silver futures contract represents a legal claim on a fixed quantity of physical metal, stored somewhere within the exchange system. Individually, each claim looks manageable. Collectively, they form a mountain of obligations resting on a shrinking physical base. Right now, hundreds of thousands of contracts remain open across multiple expiration months. When multiplied by the ounces promised per contract, total paper claims reach staggering levels. These claims represent far more silver than physically exists inside deliverable vaults. The system assumes that only a small minority will ever demand delivery at the same time. That assumption is now being challenged by changing market psychology and rising physical scarcity. Recent delivery cycles have already shown unusually high percentages of contracts standing for metal. Even modest increases in delivery demand create exponential stress when inventory is already depleted. If delivery requests exceed registered inventory, the exchange cannot fulfill its contractual promises. At that moment, the market enters default territory, regardless of how the event is officially labeled. Exchanges rarely use the word default. They prefer softer language like force majeure or emergency settlement. But the outcome is the same. Contracts are settled in cash, not metal. This instantly destroys confidence in paper pricing, because price discovery no longer reflects physical reality. Once traders realize paper silver does not guarantee metal, demand shifts violently toward physical ownership. This shift drains remaining inventory faster, intensifying the stress on the system. This is how a delivery crisis transforms into a self-reinforcing feedback loop. But delivery pressure is only one side of the institutional panic now unfolding. The second, less visible threat is counterparty risk spreading through the financial system. Beyond public exchanges, enormous volumes of silver exposure exist in private over-the-counter agreements. These contracts often involve entities that are short silver without owning the underlying metal. As physical premiums rise, these short positions become increasingly dangerous and expensive to maintain. Institutions like Morgan Stanley can see stress building through collateral calls and liquidity requests. They see which counterparties are drawing emergency credit lines and scrambling for additional margin. This signals that certain players are approaching their financial breaking point. If even one major counterparty fails, losses cascade rapidly through interconnected balance sheets. Modern finance is a web, not a series of isolated institutions. A failure in one node transmits shock instantly to others through derivatives and funding markets. Banks understand this dynamic intimately because they lived through it in previous crises. They remember 2008, when institutions that exited early survived and those that waited disappeared entirely. They remember how liquidity evaporates suddenly, not gradually, once trust is broken. They also remember commodity market interventions that rewrote rules overnight to prevent systemic collapse. In those moments, exchanges do not protect traders. They protect the system and the largest participants. This historical memory heavily influences how institutions react when warning signs reappear. Right now, silver is triggering those memories across multiple risk committees simultaneously. The combination of delivery stress and counterparty weakness creates what institutions call a doom loop. Each attempt to reduce risk by one participant increases risk for everyone else. Once this loop accelerates beyond a certain threshold, it becomes uncontrollable. This is the phase institutions are racing to exit before it consumes the entire market. The urgency behind this institutional exit becomes clear when you understand what month-end accounting forces banks to confront all at once. At month's end, every position must be marked to market and recorded on official balance sheets reviewed by regulators. Losses that can be ignored mid-month suddenly become undeniable, impacting capital ratios and credit ratings immediately. Banks cannot afford to explain uncontrolled exposure during periods of systemic stress. This is why silver positions are being purged aggressively before reporting deadlines arrive. Eliminating exposure now allows institutions to present clean balance sheets, while chaos unfolds elsewhere. Clients are being forced out for the same reason, to prevent margin failures from spilling back onto the bank. This process is not gradual. It creates violent, contradictory price movements that confuse unprepared traders. When banks close short positions, they must buy, triggering sudden upward price spikes without warning. When they liquidate long positions, they must sell, causing abrupt crashes that appear irrational on charts. These opposing forces create extreme volatility that destroys stop-loss strategies and wipes out leveraged accounts. Institutions do not care about optimal pricing during this phase. They care only about zero exposure. As liquidity providers step back, bid-ask spreads widen until the market barely functions at all. This is what a liquidity death spiral looks like from the inside. As paper positions unwind, the relationship between paper silver and physical silver begins to fracture. Spot prices may fall even as physical coins and bars become harder to source and more expensive. Dealers raise premiums because replacement risk increases, while supply chains tighten globally. This divergence signals that the paper price is no longer a reliable indicator of real value. Institutions recognize this moment instantly and refuse to hold claims that may never be honored. For retail investors, this creates a dangerous illusion that silver is cheap when it is actually scarce. This is why understanding how you hold silver matters more than the price displayed on a screen. Paper instruments rely on trust, liquidity, and functioning exchanges, all of which are now under pressure. Physical metal relies only on possession and availability. As the system strains, the market begins to separate holders from owners. Those holding paper own a promise. Those holding physical own the asset itself. This distinction becomes decisive when exchanges intervene to preserve stability. Rule changes, trading halts, and forced settlements always favor the system over participants. Institutions are exiting now to avoid becoming collateral damage in that process. You are witnessing the narrow window between institutional action and public awareness. Once this window closes, options disappear rapidly and decisions are made for you. This is the phase where doing nothing becomes the highest risk choice available. Risk management, in times like this, means prioritizing survival over optimization. It means understanding that volatility is not opportunity when the structure itself is failing. Those who prepare early maintain control, while others are forced to react. Silver is not just a trade in this environment. It is a stress test for the entire financial system. Institutions have already delivered their verdict through their actions, not their words. They are exiting before the countdown reaches zero. The public will not receive a warning bell when the transition becomes visible. By the time confirmation arrives, the paper bridge will already be gone. What matters then is not what you believed, but what you chose to hold when the system finally broke.